In this video, we'll discuss the matching principle and how the matching principle requires accountants to book adjustments for merchandise inventory, adjustments for accrued expense items, and adjustments for accrued and deferred income items. The matching principle. One of the fundamental concepts of accounting is the accrual basis of accounting and the matching of expenses with the revenue they generate. Under this matching principle, revenue is recognized when earned, not when cash is received. Sometimes both events happen at the same time. For instance, on a cash sale, both the cash is collected and the revenue is earned. However, if cash is not collected immediately, revenue is recognized when the sale is complete. A sale is complete when title to the goods passes to the customer or when the service is provided. For sales on account, revenue is recognized when the sale occurs, even though the cash is not collected immediately. Revenue recognition is a very complex topic in many industries. For instance, this is subscription revenue in the software industry. What happens when the cash is received and the revenue has not yet been earned? Then the cash is a company liability until such time that the revenue has been earned. Under the matching principle, expenses are recognized when incurred or used, not when cash is paid. Sometimes both events happen at the same time, but when they don't, each expense is assigned to the accounting period in which it helped to earn revenue for the business, even if cash is not paid at that time. Accountants spend a lot of time on these two topics. In the area of revenue recognition, for instance, companies constantly examine what portion of revenue can be recognized. Sometimes the company doesn't yet know for certain how much it has earned. How is that possible, you ask? Well, some contracts contain contingencies, such as the ability to demonstrate savings for the customer. I've seen that quite frequently in government contracts for health insurance, such as Medicaid and Medicare. So at what point would you recognize this revenue? In the health insurance industry, actuaries and accountants spend a lot of time on mathematical models and operational data to understand what the probabilities are that the contract requirements for the revenue have been met. As an example of accrued income, when accountants estimate the amount of revenue that has been earned but will not be known exactly until some future period. Accountants also spend a lot of time on expense accruals, the estimate of expenses. There are a lot of areas where the exact amount of accounts payables are not known. For instance, there may be a pending lawsuit that has a good chance of resulting in the company having to pay not only legal fees for lawyers, but also perhaps a settlement to the plaintiffs. Accountants evaluate in collaboration with the legal team whether there's enough certainty of an unfavorable outcome and estimate the outcome. Sometimes there's a range of possibilities. For instance, it is estimated that the settlement could be between $10,000 and $50,000. In that case, we would accrue for the lowest end of the range, which is $10,000. In some industries like insurance, actuaries and accountants spend a lot of time estimating expenses. For instance, health insurance companies don't really know the exact amounts that doctors and hospitals will submit for a specific month in insurance claims to the insurance company. Sometimes the amounts are not known until many months in the future. So the accountants must record an estimate. But how exactly do you estimate that? Based on prior experience, based on mathematical models? Typically, it's a mathematical model prepared by actuaries in the insurance industries. In other industries, these models may be prepared by the finance or accounting team. Regardless of who prepares the information, though, it has to be thoroughly vetted. I've seen a few examples where the Excel model had an error that wasn't discovered until later.